Normally, in times of uncertainty and volatility, people run from small caps. Explain why you think that might be a bad move.
Yeah, good to see you, and thanks for having me. I think, as you say, normally small caps are not the size segment you want to own if you're in a downturn, going into a potential recession. Our economists are looking for a mild recession next year. But I think today there's some fundamental differences in the backdrop. And I think importantly, small caps have been pricing in a lot of the risks already. So, when you look at the forward PE multiple of the Russell 2000, it's trading at, around 11, 12 times recessionary lows. It's the only size segment within the market, equity market, that's very cheap versus history right now. Large cap multiples have come down more to in line with average, but they're still not historically cheap. And when you look at that relative multiple of small versus large caps, trading almost the lowest levels we've ever seen outside of briefly during the tech bubble. So I think small caps are pricing in a lot of the recession risks already. The equity risk premium of small caps, when you look at the Russell 2000, is at record highs, whereas for the S&P 500, it hasn't risen as much as it typically does, even in a mild recession. So, especially for investors with longer time horizons, this looks like a really great opportunity to own small caps, overweight small caps relative to large. And that was really what we saw during the early 2000s after the valuations were last time this cheap. That was a great decade to own small over large.
And do you think now is the time to get in, or are you willing to go in and deploy cash right now in small caps?
Well, I think, there's obviously risk that the market remains volatile near term. The consensus economic forecasts have not really been fully baking in, what we're expecting, which is a mild recession next year. We think earnings forecasts still have room to come down. Although at this point, again, small cap earnings have been more quickly adjusting to reflect that expectation than large cap earnings have, which have remained much stickier. And I think, we could see further volatility near term, but we actually think there could be more downside risk to large caps than to small caps. Once the markets bottom out, typically early cycle environments tend to be the best phase for small caps. But I think there's still fundamental reasons that small caps could hold up well in this current backdrop as well. We've seen CapEx spending and CapEx guidance by corporates hold up really well, even in the most recent earnings season. And small caps tend to benefit from CapEx cycles in the U.S. more so than large caps. They should benefit from reshoring of U.S. manufacturing, and the guidance for small caps has held up, during the most recent earnings season. So certainly room for further cuts to estimates, but we think that small caps have been, pricing in these risks a lot more.
Let me jump in with a sort of final question here, Jill. We don't see as many small cap managers as we do large cap stock folks here on CNBC, but a lot of your brothers and sisters in your business say what's really important right now are strong balance sheets and reliable, if not growing dividends. And I want you to talk about that within the context of small cap shares. I'm guessing that a greater percentage of them do not have fortress balance sheets than some big cap stocks. Not to say that big cap stocks are immune to that problem. And I'm guessing that they're less inclined to pay plump dividends, right or wrong?
Right. So I think, you're right. Typically, a lower proportion of small caps are going to pay dividends. And the Russell 2000, when you look at it as a benchmark, is going to be a lower quality benchmark in terms of, the number of stocks that are actually profitable. About a third of the index are non-earners. They don't have profits. But I think, what's interesting is, number one, if you look at the S&P 600 small cap index, that's one we've been highlighting as a higher quality area of small caps. Only about 10% of those stocks are non-earners. So it's a higher quality benchmark, less exposure to areas like, healthcare and biotech, where healthcare is still ranked, much more weakly, worse.
Is that where you do most of your stock picking? Do I infer from that that's where you do most of your stock picking, from that higher quality benchmark?
Yeah, we do like quality as a theme overall within small caps. I think, within small caps, we would focus on quality stocks with strong free cash flow. Interestingly, the S&P 600 dividend yield has been trending above the S&P 500 dividend yield. So, and dividend paying stocks within small caps have been rewarded this year. So even within small caps, there's been a big performance dispersion between dividend payers and non-dividend payers. You don't always think about owning small caps for dividends, but I think right now that's a theme that's going to work. So overall,
well, that's interesting.
That's a benchmark.
So the S&P 600
higher.
has a higher dividend yield than the 500, than the S&P 500. Did I hear you right?
Mm-hmm. Yeah.
Boy,
interestingly,
you once again, you told me something I didn't know. It's not that that's a really high bar, Jill, but feel good that you educated me on that. Jill, Carey Hall, we appreciate it.